one guy turned to the camera, he goes, we talk about flipping homes and we do that. He goes, but that's not how we make our money. How we make our money, he goes, we're going to show you our quote unquote renovation, non-flip of our investment properties. And I got my head going, what? Like I'm watching a flipping show. And the guy's basically telling me, he goes, that's not even the host was telling us, that's not how they make majority of their money. Majority of their money is.
Ladies and gentlemen, welcome back to the DC Talks podcast. I'm your host, Agent Double O. Look at Dave cringe when I say that every time. And we're back in the studio. And you know what, Dave, man, over the past couple of episodes, we've been talking a lot about investing in property, but there's a topic we haven't really touched upon, which is flipping houses, right?
Oh God, yeah.
A lot of people want to make a quick flip. They see a distressed property.
They watch HDTV.
You were on HDTV.
Yeah, I know I was.
Too, right?
So anybody could flip a property, right? It's so easy,
it's
right?
So easy. You make a quick flip. You know, you walk away with like 50, 60 grand, but we know there's a lot more work that goes into it, right? So first and foremost, what are your thoughts on house flipping?
Unless you're part of it in the industry, so whether you're, have your hands involved, whether you're an electrician, a plumber, contractor, somebody that knows what they're doing, I would stay away from flipping. The risk side is just way too high. The reason why I say if you're part of the trades, sometimes they barter back and forth. Okay, if you do my plumbing, I'll do your electrical in the next house. You can save some money. And when it comes to flipping properties, and the builder's good at that too, it all comes down to a lot of the numbers and what your margins are. If you're somebody who has to hire somebody, your margins are just not going to be there. Like, because a lot of equity can be built in a property, and income can be built in a property based on your sweat equity and what you're able to do with that. If you're just a casual onlooker and this is kind of like something you quote unquote want to get into, it's not easy, right? And then you also have to deal with maybe contractors which aren't good at what they're doing, right? And then firing people, it's a full-time job. So there's a lot of risk involved in that. And I've seen people obviously try to flip properties and, it's lose money on it as well. Now, I've seen some people make some good money, but they're smart about it. There's ways you can make money on it and still hire contractors. But if you're trying to do a quick flip, like remember, real estate is a long-term investment.
Absolutely.
It's like, buying stocks. If you're day trading in stocks, you're exposing yourself to risk, and that's, potentially could really hurt you. It's the same thing with flipping homes, right? But, if you did like something, if you looked at the neighborhood, figure out what a property could sell for in this market, you get a good price on it. And if you buy a property, which you can rent out for a few years, to help some of that bleeding, while you can go through some of the planning process with the city, making sure that the property is set right, that you're not going to make any bad mistakes, and you can afford to do that. Well, obviously you're building in some time into there, which also helps to build your equity. So quick flips don't always work. Don't always work. Well, and you also have to figure out the market can change too, right? Now there's some people that are able to flip properties early 2022 or late 2021 because there was lack of inventory. I saw one person buy a property for $800,000 and flip it as soon as he took the keys 2 months later and sold it for a profit for $100,000.
Wow.
That doesn't always happen. That's an anomaly. That usually doesn't happen in everyday market. To say that doesn't happen, sure, it could happen and you could get lucky doing that. But imagine if the tables were turned the other way. You bought property for $900,000 or $800,000, say $900,000. The market turns, now you're losing money. Now the property's selling for $700,000. If you wait 5 years, you'll be back. Obviously you'll be back in the money, if not made money on that property.
So in that case, let's frame the conversation for that person who believes they can actually flip a house. So, okay, you know what? I heard what DC says. You need to be this, and that. But they believe that they can go out there and do this on on a full-time basis. They can find properties and get them done. So which can be done. Which can be done, right? But to you, what should you be looking for while assessing an undervalued property or, under, it just doesn't look like it should be, but what should you be looking for when you see that type of house? Yeah.
So a lot of times you want to look for properties. Sometimes they're maybe a little disheveled. You want to look for properties. Maybe the house has been on the market for a very long time. That also helps. Like if a house has been on the market for say 120 days or 180 days and you have a lot of cash, you're able to purchase that property, there's no financing, all that you need on it, that also helps because that means you can bring the price down. So these are kinds of things you're looking for. You're looking for property in an area where a precedent is already set, in which if you're able to flip a home, if it's a big flip, knocking down the home and build on it, well, what are the houses that are knocked down? What are they built for? Like run those numbers, right? The other thing is I like looking at disheveled properties, back to that, because you might see a diamond in the rough, right? Exactly. So sometimes some people, especially in a quote unquote, buyer's market or equal market, some people just want turnkeys. They're not looking at that property. Well, then that's also something you're looking into. Again, if it's a little disheveled and it's been on the market a very long time, and you could probably do more of a quote unquote lipstick flip and be okay with it, right? But we're just noticing even now in this type of market and markets we've seen the last few years, there's not a lot of properties that fulfill that criteria.
One of the key things you mentioned earlier is that there's a lot that goes into it. When you're looking to flip a house, what is a pragmatic way to setting that budget to understand that if this is my budget, this is what I'm going to do it. And then also there's also leakage in costing as well too. So talk about setting the budget and also factoring in for leakage if something were to happen.
Yeah. So first off, you want to know if you're purchasing the property, don't forget to factor in all of the costs that are associated with the closing of that property. So if you pay something $1 million, at the end of the day, you're not paying millions. You have to pay land transfer tax. You have to pay, lawyer fees, everything on top of that. The second thing is also when it comes to leak, you want to see what properties could be sold in this market now if you're building on it, but cut it back, like maybe evaluate it at 85 to 90% of that value. And when you look at that saying, well, this is what I would sell over here, because you're being conservative, right? And also factor in your real estate fees into that, because on the sell side, you have to factor that in. So that would also help you with a little bit of leakage as well. And so you're looking for a property that, that you can figure that out, that makes financial sense. And when you're looking for contractors, don't just, if you're not doing it yourself, I hired talk to 3, 4, or 5 of them contractors. Don't go with the cheapest person. Look at some of the history they've done, like what is involved in the process.
Absolutely.
Nowadays, we also have to worry about, anti-flipping tax, and I'll get into that a little bit. But if you're owning a property, say you want to do a flip like this in which you're able to budget and you're able to do like a quick flip, let's call it. Well, in the past, you were able to, flip a property and only have to pay capital gains on it if it's not your principal residence. So which means if everything is said and done, like what is your actual net income from the property? You would be taxed on 50% of that. So say, for example, you purchased a $500,000 property and you sold it for $1 million with incidentals. You actually made a profit of, say, $400,000. Well, half of that you get taxed. $200,000 gets added to your income, not the $400,000. The new anti-flipping tax that means if you sell a property within a year, you get taxed on that full $400,000. So if you made $100,000, all of a sudden now you're making $500,000. That's what you're going to get taxed on. So and if that'd be in the higher tax bracket, 54%, whatever it is. Yeah. So you're getting heavily taxed on that. So pretty much, you're giving away a lot of money.
I see. You've given like a good solid groundwork on flipping, but have you flipped a house? I know your dad was in real estate very early.
My dad didn't like,
he didn't like flipping.
My dad didn't like renovations at all.
Really?
No. He was always reluctant to do it. And we were always pushing him. He would put Band-Aids on things. Yeah. He wasn't the guy.
He didn't want to start from scratch and then build the top up.
The first property, and I think Natalie and I pretty much we flipped it over a longer period of time. Like we bought in 2007 and then we renovated, lived in for a bit and then rented it out and then sold it. That was quote unquote a flip, but it was a long play flip and it worked out well. I've sold properties for my clients, which were quick flips. Me personally, I don't have the appetite as much as I love real estate and I like risk. Not ish. A quick flip like that, we've looked before, it just hasn't panned out because my numbers didn't work.
Yeah.
Not to say I wouldn't do it because I'm in the industry now and I have a good network of people behind me. But it was one of those things that, no, I haven't done a quick flip.
Never done a quick flip.
Not a quick one. No, I prefer to buy properties, hold on to them, rent them out, and let the equity build on them, and then pull the equity, buy other properties. So letting your tree grow. The only time I like to sell properties is when I know I can buy something else with equal or greater value for rental income. If I find, like I don't know if I've told you my strategy, for example, for pre-construction condos and what I do with those. It's a prime example. So my wife and I have bought like, well, I think 4 pre-construction. Some of them haven't been built just yet. And remember, it's time in the market, not timing the market. So good thing about some pre-constructions in the past, it's changed a little these days, but you're able to buy pretty much a market value pre-cons, if not less. Some of them we bought less than the resale value at the current level. And because pre-constructions take anywhere, sometimes 3, 4, 5, 6, some of our projects have been 7 years, they're built. In that time, equity's been building. And we've put down 15 or 20%, whatever it is. And that's until you get the keys of the property. Now, my strategy is once we get the keys, we've already built like 7 years of equity, let's say, built in there 3 or 4 years. Values of most of the time, they've all been gone up. I pretty much, when I get the keys, I could sell it for a profit. Now, again, with that anti-flipping tax, you don't want to do that.
Exactly.
And the second thing is on a pre-construction property, if you're not the end user, you have to pay HST. I think caps around 26,000. I don't know if they've changed the laws yet, but it was capped at 26,000. You're able to get majority of that back, or a good chunk of that back, if you rent that property out for a year. So once you have a full year lease, government regulated lease signed by your tenant, you can apply to get that HST back. So it doesn't make sense if you sell, even if you buy a pre-construction property and you're the end user and you're living in it and you still sell within a year, you still have to pay that HST. You have to pay that back.
So how do you beat it? Do you like wait 2 years, or what do you do?
Now we're getting my strategy. Yes. So my strategy is you hold a pre-construction property for I would say anywhere between 4 to 7 years after you get to the keys. Okay. I used to say about 5 years, something like that. But it's changed. Sometimes every property changes. Now, reason why is, A, you don't have to pay that additional HST to the government. You're not paying anti-flipping tax. Not paying vacant tax either if it's rented. But think about it. When people are first selling that property right away, sometimes it's for foreign buyers or buyers who just want to dump and make a quick buck. And therefore, it's an artificially low market. They don't really care because they've already made some money on it. They haven't moved into it. They just try to cash out.
Exactly.
So the value has dropped, right? It's not a real market. Well, after about 3-4 years, the market gets established in that unit, in that building. We're talking condos, for example. And you have more end users, people are actually living in it. It gets a nice little buzz. It's still a fairly new property. Well, because it's still a fairly new property, your maintenance fees also have not increased. So when you're renting a property, majority of renters, like landlords, cover the maintenance fees and the taxes, and the renters pay, their own utilities usually. So if maintenance fees start to increase, that eats into your gains, right? Into your profit. Well, because the property is fairly new, you don't have to replenish a lot of the reserve fund because, you're not having to fix your windows, your doors, or hopefully there's nothing wrong with your swimming pool, stuff like that. But as the property ages, then those things start to break down. They're going to have to dip into that, into the financial reserve. You're going to have to replenish that, and your maintenance fees start to go up higher, quicker. So that also affects your cash flow.
Yeah. And that's just the game. That's just the nature of the game, right?
Yeah.
It comes with it. Back to the flipping of everything, right? I was curious to understand more because we spoke a lot about mortgages and financing options. When you go to a mortgage lender and you're telling them, hey, I want to get a mortgage for this property, I know the after repair value might be worth, let's say, $800K, but the value of the property as it stands right now is this. Does the mortgage lender ask you these questions of what you plan on doing with the property before they give you that mortgage?
A lot of
and
times,
how does that affect your financing when you get it?
Yeah, like for example, if you're going to knock down the property, like you might not get a mortgage for it. Like,
Really?
Because the bank is taking on a lot of that risk, right? I was told when I was first doing this, and I was thinking about flipping properties, and don't quote me on this. They're like, knock down most of the house and then tell your bank, oh, sorry, I knocked down the house. Can you help give me a construction loan for this? I don't suggest doing like that. I like back in the day, I remember people, that's what they would do. Like they would They'd buy a property, it's $500,000. They'd have all the plans, not tell their bank that they had any plans of doing this. Because in order for a bank to give you a mortgage, it's got to be like 95 or 90% livable. Like you can't knock it down, because that becomes higher risk and therefore it's a different mortgage, right? And again, I'm not a mortgage broker. This is just what this is what I know.
Exactly.
That I've literally heard of some of my contractors going there, like they had all the plans and they took a bulldozer and knocked it down. And then they called the bank and said, oh, by the way, we knocked down the property. And if you want to get your money back, I also need a $500,000 home equity line of credit in order to bring it back to standard.
Are there penalties to that?
What's a higher rate?
Is it ethical to do that even as if you're borrowing? Because how can they even check if I'm giving you the money as the lender and I know you're going to buy this, how do I not know you're going to go behind my back? Are they coming to check to see if you're actually doing that? What are the boundaries the banks and the lenders have to make sure that their money is going into the property?
Talk to the brokers and talk to somebody in the banks, because they know it's a little bit of gray areas for us. I try not to touch on that because that's not my expertise. But I'm assuming a lot of times they don't know what's going on with your property. I'll be honest with you. Like with the ones they have, like I have a couple of houses at this point, and they don't come check to make sure I'm living like they're not like when my rental property, my sixplex, for example, like I don't see them coming in. We're doing work and seeing all the stuff. Like I have, for example, outstanding permit on it to add, where we added sprinklers stuff in there. The bank has no idea.
Yeah.
I pay every month.
Yeah.
They don't know.
Yeah. In our culture right now, there's this obsession with investing in real estate where a lot of people are looking just to find any way to get in the market. And have you heard of this thing called micro flipping?
No. Maybe I have. Maybe it's called something different. What do you consider this?
So micro flipping is essentially like there's a stock market for flipping houses. So you actually don't even buy the house. Essentially, you go to like a website like a Zillow or something like that, and you purchase the property, but then you list it up in the market, and you might list up for like, let's say if you bought the house for $500K, you list it for $530K essentially. So you're essentially taking your money, buying the property, and then just selling it for a profit margin. So a lot of people, they're trading houses. So for the new investor,
God, that sounds
it's like
so tedious.
You're trading property every single time. Like, but you need a huge cash base to do this. But the results you end up getting for all the stress that you're putting up with it is a measly profit of like 5 to 10K. But the thing is, it takes time to materialize. And this is what people don't know. So this is what I'm saying. The real estate market has taken on its own life, where this technology now, where people are making a stock market of real estate flipping. It's insane. I
don't agree with that.
You don't like that?
No, I don't like that at all.
I can see someone like you doing this, Dave, to be honest.
I just find it's a lot of work for a little bit of payout to me, because you're like making sure what happens. Well, for example, what happens if you buy that $500,000 property and all of a sudden the value's dropped to $490 and you're trying to sell it for $530? Like, and now you're going to be losing money on it. Like,
but if I were to play devil's advocate, I can also say that if you're buying a stock at a certain price, that price can also drop and you're going to lose money. So it's the same thing.
Yeah, but the stock market is a lot more volatile, right?
Okay.
If you look at the Toronto Real Estate Board, albeit sure, maybe not since 2021 to February 2022, but it's been, most of the time, it's been fairly reliable. Over 6 to 7% per annual return on an investment property. It's an older, mature market. Think about a Coca-Cola or beer or something like that. So the market is not supposed to fluctuate, and that's what an older market. That's usually the characteristics of it, and that's why we always say it's better to be time in the market as opposed to timing the market. It doesn't matter when you purchase a property; it's how long you hold on to the property. If you're doing this micro thing, then it's like it throws everything we've learned out the window. It's like now it's like you're adding risk for low income, for like, again, just to me it's a little payday, because you're speculating on the market. That's not how real estate should be. Let's be honest. It's just, it doesn't perform well for that type of market. And just, I think you're setting up yourself for a lot more risk than the reward is worth.
Yeah, real estate.
I know you're trying to push me, trying to say, "Oh, this is a fantastic idea," but that sounds to me, it sounds atrocious.
If you're a tech bro and you're like looking just to flip anything, you know how you flip NFTs, you're flipping stocks. Like, real estate is the new thing.
Yeah. Well, again, real estate's a little bit different because it's tangible, right?
Yeah.
So there's a lot more, and then there's also emotional aspect with the real estate or residential real estate market. Like there's just so many different aspects of it. When you look at NFT, like digital pictures of a cat, like come on. Like that's not how I can't live in that shit. Like I don't care what anybody says. Oh, NFT, I made like $4 billion. I'm like, fuck, what happens if you lose that NFT? Like literally what happens? Like it's hard to lose a house. Like you can if a fire, but then there's insurance and stuff too. But it's like it's not physical. And that again, I'm old school that way. I just can't wrap my head around.
Did you see that? Did you see how the guy bought the first ever tweet on Twitter as an NFT?
I've heard about that.
He bought Jack Dorsey's tweet saying hello Twitter.
Yeah.
He bought it for $1 million, right?
How stupid.
He bought
Sorry. I just don't get it. I'm really old school.
This is what we call hustle culture, bro. But you know what it's appearing now is real estate culture, bro. You know, real estate hustle culture? Like it's becoming like this whole thing where, oh, invest. It's like, could we talk about what you're talking about, the pragmatic way of doing it? Start with one and then go from the next one and then build up from the thing. But we're looking
time in the market, build equity. Like, listen, let's go old school. Like anybody who's doing things old school, and I don't care what industry you're in, like even some of the new style of doing this is still rooted in old style stuff. So if we're looking at old style, like you're talking about building equity in a property, it's time in the market, it's that kind of stuff. I don't care what technology you have, it's like that'll always work, right? Like as long as the market continues to increase, right? The problem we had a lot of times with the session we had in Toronto was that we had so many fantastic years over years of progression of increasing. And I talked with my, my financial planner, and we talked about this too. So he goes, the problem is we've always had such good increases and nobody ever anticipated a drop like we've had, right? And which we all knew was going to happen. We kept saying it will happen. We're just not sure when or how much it's going to be. And we know it does rebound. So that's why we say time in the market. But there was people literally looking to flip properties and buy properties that got burned because they didn't pull out a calculator and figure out what would happen if interest rates increased by 2, 3, 4%. What would happen if when you go to sell this property, you're running in the red? Like they didn't actually run their numbers, or like, so that becomes a problem because they always feel that the market's always going up. Well, that's also not very pragmatic either. Like we always have to anticipate some sort of risk. If you purchase this property, if the value drops, can you hold on to that property? And again, it matters the time in the market that you want to be. You have to have some sort of fail-safe, some sort of parachute, some sort of, if you're looking to get into this, have an iron stomach as well. Because right now, some of my investment properties right now are losing me money. It's not keeping me up at night. It's just a matter of like, I know they're going to rebound. They're earning money. It's just the way it is. It's just the part in the industry right now that we have to live through. And that's some of the issues we're getting right now, is that people don't get that. And that's why like they didn't pull out a calculator and figure out what the end results were, or just didn't anticipate that. And that's why we're seeing a lot of these assignment sales, because they just can't afford to close on them.
Absolutely. And to circle things back to the flipping,
the circle,
right? Circle of life, circle of DC, like the logo in the back. Pros and cons of flipping a house. Talk to us. Give us the pros and give us the cons.
Well, pros, it could be a lot of upside, obviously great income. It's a great way to actually see your investment and your ideas come to fruition. If it's a great way of, of building a business and building people, like building that way, because if you're able to do it and you're able to figure out how to flip a house correctly, you're able to replicate that over a vast majority of properties, and it becomes systematic and you can make a lot of money that way. And the pros to that, you can build really good relationships that helps bring probably down the cost. So if you're building 2, 3, 4 houses at the same time, you get economies of scale, and that also helps you with your bottom line. The cons, there's a lot of risk. Let's be honest. And there's a lot of con artists out there too. And there's people that overpromise, underdeliver. Timelines could really affect you. If you don't have a lot of money in case there's a rainy day, you could lose your whole investment, if not your own personal wealth, right? If you're using your own home as equity to do this flipping project and that goes south, well, it just doesn't stop there. They can come after your home. Like you could lose literally everything if you're not smart. So there's a lot of downside to it too. I'm not a proponent of flipping. And the reason why I keep saying, third time in this podcast, I'm going to say it's time in the market. Well, why do I say that? If you look at, even I was watching this flipping show before I was on HDTV and all that crap. I don't mean crap. I love being on HDTV. Let's not say that. But I'm just saying before people associated with that persona, because they put you into this fake persona, right? Of like, oh, you don't really know what you're doing. You're just like somebody on TV. Like, no, this is something I actually do. I remember watching a flipping show, and there was these three friends, and they were started in Connecticut, and they started showing you. So like one guy turned to the camera and goes, "We talk about flipping homes and we do that." He goes, "But that's not how we make our money. How we make our money," he goes, "we're going to show you our quote unquote renovation, non-flip of our investment properties." And I got my head going, what? Like, I'm watching a flipping show, and the guy's basically telling me, he goes, that's not even the host was telling us that's not how they make majority of their money. Majority of their money is buying properties, holding on to them, and renting and pulling equity so they're able to fund their flipping projects, which is like their baby,
their toys.
Yeah, exactly. They're able to do that. So it's just funny, the dynamic. But that was one of the few flipping shows I've ever said that actually came out and said, how do you think we fund this? We fund this through renting and holding on to our properties and building equity, not using our own money.
And it's a great thing you brought up HDTV, because I feel like it created this whole culture of like seeing from start to finish. There's a lot of
in 20 minutes,
right? You see all these women, and especially my mom too. When we moved to Canada, right? She had never seen such a show, because back in Nairobi, we don't see these home garden television type of things, right? So she'll see a house from start to finish. And there was like one host on HDTV, Tyler. Remember Tyler? Is it Tyler Penley? I can't remember his name, but he was on HDTV for like at least a decade. Take a house, distressed, start from ground zero, start before, after, and it just gets you excited. And then you're like, wow, like imagine the profit that must make on that. But the thing they don't talk about a lot enough about is the cost, the everything that goes within it to make it like that. So it just
they don't even talk about closing costs for crying out loud. Oh, we bought this house for 600,000. Great. So what about your land transfer tax? What about your lawyer fees? What about your additional costs? What about your taxes? What about the carrying costs? Nobody talks about that.
Exactly. But that's not sexy for TV.
It is for me. I like
HDTV. Yeah. As we're close to wrapping up, I also want to talk, as we're talking about HDTV, what was your experience like being on TV?
It was great. Yeah, it was great. There were certain things that I wouldn't say on TV, because they always said to us in the beginning, the five of us, they got us together. And I'm hopefully having at least one of them co-host on one of the shows, one of the podcasts. Anyway, they always said to us, make sure, what you're saying on camera is the persona that you want to be. And I was trying to stay true to myself. There's a couple of things we kind of butt heads about, like I wouldn't say, I'm not somebody who just chases a check, making sure for commission and all that kind of stuff too. And there's a couple of times they had to change a couple of things they wanted me to say. I wouldn't. They like, would you say this? I said no. Like, but other than that, it was pretty good. Like it was fun. I'm hoping there would always be a second season, and they could actually really see. It was funny because when I started on the HDTV show, I was getting successful, but I wasn't. I'm always getting better and better and better. You figure. So this is almost like 3 years ago. Things have changed drastically. Like we're in an office, which is different. Like I think it'd be better shot now. And a little more comfortable with my skin being on camera now too. But it's like, but no, it was a fantastic experience. And Architect Studios is the one that they did the filming stuff. They treat us like amazing. They're such great people. I don't have anything negative to say about the whole experience. The only negative thing I've said is they kept us hanging. There was about a second season, and we're like, so I guess we just came to the conclusion there probably won't be. I don't know. And so, yeah.
Can you see yourself doing more TV in the future?
I would love to do more TV. Yeah. I think it's good. It's part of, I love selling. I absolutely love being a realtor. I really do. And it's, because what happened in the past and stuff too, I finally feel like this is the niche I should have been in. So if I can help that with other people and being more real about what happens in the behind the scenes and what really happens in real estate, absolutely. I would love to be able to, I would relish the opportunity to do more TV.
Yeah. I hope that opportunity comes for you.
Yeah. That'd be great.
I think you're great for it, man. You're out here, you're providing a lot of great information. You're honest, you're authentic. Yeah. And I think we need to see more of that, because I think you provide a balance of the positives and also the negatives, but you put them in a really good light where you're not saying, okay, even though the negatives are this, it's not as bad as it could be if you don't do this, this, and that. So you give us the parameters of like what to do so it doesn't drastically get bad, but you still provide us with the negatives of what could happen.
Thanks. I appreciate that. Yeah. Well, I do it with my clients too. Like, don't get me wrong. When you're purchasing anything, I don't care what it is, there's always going to be some sort of a risk.
Absolutely.
And if you're looking to make a business, hey, listen, even starting from doing, like, I could have been a little risk less if I would have went back and being an analyst, you know, did something else, but there's a little bit of risk. You got to believe in yourself. And, you know, sometimes even, and there's also this aspect, you got to listen to your gut as well. I'll give you that and maybe listen closing, but you can run the numbers till the cows come home. But if something, even if the numbers aren't working out, but something is telling you that you need to do this, whether it's, you know, your gut, your God or whatever it is, it's like, if somebody's telling you to do that, you'd be surprised. Sometimes it works out in your favor.
Yeah. Exactly. Amazing said, DC. Well, ladies and gentlemen, that has been episode 16 of the DC Talks podcast. Remember, it's the time in the market that matters the most. As DC says, we'll be back next week for episode 17. Have a great week, and we'll talk to you soon.
Yeah. Don't feel free to reach out to us either. We love, you missed that part.
Oh, yeah.
We want to like, subscribe, all that fun stuff.
And
everything. Follow me on Instagram.
Follow DC for more content and more clips. And we'll chat to you soon, everybody.
All right, guys.
Peace out.
Ciao.